My name is Pat O'Connor. This is video number 18 in my National Mortgage Exam tutorial series. I'll be giving definitions for some terminology that you need to know. The information in these videos comes primarily from the study guide that I have published on Amazon. It has hundreds of questions and answers. It's a good overview of the business in general. And it has 2 practice exams. At the end of this video, there will be instructions on how subscribers can request a link to quizzes. And if you follow through to the end of the video, you will get those instructions. All right, let's start. Subordinate loans. Mortgage liens are usually recorded in the order in which the documents are signed. So when you get a mortgage, then it will be recorded and you can see it in the property tax record. So if you get 2 mortgages at the same time, for example, a purchase mortgage for 80% and then a second mortgage purchase loan for 10%, the purchase loan will have a higher mortgage position. They will get paid off first if there is a foreclosure or short sale. The second purchase loan will have a subordinate position. It will be underneath that purchase loan. It's riskier for the lender if you are subordinate, so they generally have higher interest rates than the first mortgage because there may not be enough money left for during a foreclosure to pay them off. So they counterbalance that by charging higher interest. Escrow accounts. These are the accounts that loan servicers set up to keep the 1 month of property tax and 1 month of hazard insurance in an account. Borrowers may not have to have an escrow account if lenders allow them to pay for their own hazard insurance each year and to pay their own property tax each year. But if they don't, 1 month's worth will be collected along with your mortgage and interest payment. A lien. The lien is evidence of a debt. So when you get a mortgage, you have a mortgage lien. If the IRS comes after you, you will have an IRS tax lien. If you don't pay your general contractor, you're going to have the contractor's construction lien on the property. Tolerances. For the purpose of the exam, tolerances are the allowable differences between fees that are charged on the loan estimate versus the liens that are charged, the fees that are charged on the closing disclosure. So things like loan origination fees, 0% tolerance, variance. They have to be on the same as a loan estimate and the closing disclosure. You have 10% for things like recording fees. You have an unlimited amount of tolerance for items like per diem mortgage interest, right? It may be initially calculated on a particular closing date, but by the time you get to the closing disclosure, you may have had closing date extensions on the deal. So it's not going to match what's on the loan estimate. So those can have an unlimited amount of tolerance. A rate lock agreement, this locks in the interest rate. And they usually have an expiration date. Okay, so it's locked in 30 days, 60 days, 45 days, whatever it is. Table funding. This is where mortgage companies who are approved wholesale traditional lenders can process, originate, and close the loan in their own name. They may not have to use any funds for this because they can assign the loan right after the documents are signed to a lender who will then fund the loan. Why do mortgage companies do this? Because the lenders will pay them an assignment fee. They didn't have to worry about processing the loan. They didn't underwrite the loan, right? The mortgage company took care of all of that, and the lender obviously approved of the process. And so the mortgage company will get an additional fee for this. So that's called table funding. And it may be illegal in some states. I think I read that you can't do it in California. Yield spread premiums. It's the difference between the par interest rate, break-even rate, and the higher interest rate that's charged to the borrower. Back in the olden days, before mortgage reform, loan originators, if they charged a higher interest rate, would receive a larger compensation from the lender. But that went out with the loan origination rule. So now yield spread premiums are the basis for lenders' credits for the closing costs to the borrowers. And we'll talk about that in a minute, what a lender credit is, and I'll go into that. Federal mortgage loans, those are the FHA loans that are 100% insured by HUD, and the VA and USDA loans that are partially guaranteed by the government. So the lenders who do these loans are either 100% insured and will not lose any money on the deal, are partially guaranteed and losses will be covered up to a certain point. And those are the government loans. Servicing transfers, it's when you have a change in loan servicer. Could be that all the consumers were complaining, they got a lot of complaints about a particular loan servicer, so it was changed. Also, the mortgage and note can be reassigned or sold various times throughout the life of the loan. And the new holder of the mortgage and note may then sell the servicing rights to someone other than the previous loan servicer. And so that's what servicing transfers mean. Lender credits. This is where a lender will contribute towards the closing cost of the borrower. And it can be upfront. The borrower has the choice of paying a lower interest rate, a par interest rate, and paying all their own closing costs, or they can accept a higher interest rate and the lender may contribute the yield spread premium, the difference between the two, maybe 2% of the loan amount, towards paying the closing cost for the borrower. And that usually does not include the down payment, right? They want that out of the borrower's funds, typically. But other closing costs, title insurance, attorney fees, that kind of stuff. Discount points. This is the borrower may negotiate with the loan originator if they have a lot of cash, extra cash, and they want to lower the interest rate below par. So they want to lower interest rate than what is on the rate sheets that you as a loan originator will use. They're not going to get it for free. They're going to purchase discount points. And a discount point is typically 1% of the loan amount. How much does it lower the interest rate? Anywhere from 1/8 to 1/4% lower. Is it worth it? It depends. They can do the math and figure it out for the life of the loan or how long they intend to keep the loan. They're not necessarily planning on keeping it for 30 years. So they can do the math. They can see if it's worth it. It also may help them qualify. If there's a lower interest rate and you guys have already been through the class before, so the debt to income ratios, the PITI depends on the interest rate, right, that they're paying. If they can pay to lower it, they can get a loan, whereas they might not have been able to get a loan before. So when you are qualifying them and they don't qualify, but they have some extra money, bring this up to them. Would you like to purchase discount points? And you may get a deal where you might have overlooked it before. A 2-1 buy down. This is an expression that means a lender will offer 2% lower interest rate below par for the first year and 1% interest below par for the second year, and then it'll go to par. Why would they do this? Builders, if they have their own seller financing, it may be an incentive to have people use them as their financier rather than Bank of America. Come to us, we built the places, we provide the financing, and we'll give you 2% lower first year, 1% lower second year. Okay, loan to value ratio, LTV. If you've been through your course, then this should be ingrained in you. It is the loan amount divided by the lower amount of either the purchase price or the appraisal value. And this is the percent that the lender will finance. So if the appraisal value is lower than the purchase price, then somehow the difference between the two has to be brought as cash to the closing table. Okay, so LTV, loan to value, either purchase price or appraisal value. And that's the lender's position in the property, percentage of ownership. Not ownership, but financing. Accrued interest, the monthly interest that accumulates, mortgage interest that accumulates during the month, right? If you pay it off on the 1st, then on the 2nd, you start accruing the interest. Finance charges that the borrower wouldn't pay if they were paying cash. So things like your fees, interest rate, you pay cash, you're not going to have interest rate. So those are financing charges. Also called the cost of borrowing money. Daily simple interest. Now the mortgage interest can be calculated by dividing by 12 because there's 12 months, or dividing by 365 days. So the daily simple interest rate is when you have an interest rate and it's divided by 365 days, and that will give you, and then you multiply that by the loan amount, and that will give you the amount of the daily interest. The daily interest, simple interest mortgage is usually a little bit higher than traditional mortgage. So you as a loan originator see how your lender calculates mortgage interest rate. You're either going to be dividing by 365 or you're going to be dividing by 12. Okay, subordination. Again, this is when a higher lien mortgage loan or any loan agrees to assume a lower lien position. When would they do that? One example is in a short sale. You have your purchase mortgage, right? That's typically the senior mortgage. And then you might have a second purchase money mortgage below that, or HELOC. And for the short sale, what the second lien holder may insist on for the short sale to go through and the lender to get the money and avoid the whole foreclosure mess, they may insist that the senior mortgage subordinate their lien so that that second mortgage is now superior and will be paid off first from the proceeds of the closing. Okay? And if there's not enough money to completely pay off the, say, purchase money mortgage, too bad for them. All right? And so I personally know some short sales are killed because the senior mortgage holder will not agree to subordinate. Conveyance. Transfer a property or a lease to another party. That's all. Primary, secondary market. Primary markets where the market where the original funding occurs. Borrower gets the purchase mortgage on their home. Well, the lender is probably not going to keep that in their portfolio. They're going to sell it in the secondary mortgage market, maybe to Fannie Mae, maybe to somebody else if it's not a qualified mortgage. All right, and then that is the secondary mortgage market. So the original funding is primary. Any later assignments of the mortgage and note, transfer of ownership for a fee, is the secondary mortgage market. And Fannie Mae and Freddie Mac are a huge part of that. Third-party providers. One of the laws prevents, third-party providers from contributing down payment costs for the borrowers. And so the third-party providers, not the laws, but, rules for FHA and whatnot. So third-party providers in this case would be real estate agents, title agents, the appraiser on the deal, the people that are in the orbit of the closing, but they're not the borrowers or the sellers. Assumable loan, the new borrower can take over payments of the seller's mortgage, and these are the government loans. So the same terms, FHA, VA, USDA loans, they're all assumable. APR, annual percentage rate. It's the actual interest rate. Say, okay, we'll give you, right now they're being quoted like 5.5%. Recording this in July 2022. 5.5%. But APR is what would appear on the loan estimate. It used to be part of the truth in lending disclosure, was the APR, because it's the quoted interest rate plus the financing charges. So it would include loan origination fee, maybe discount points, those type of charges. Okay, so right now, the instructions on how subscribers can request the quiz should be above my head. And in a few seconds, you will see links show up for additional videos in this series. Hope you enjoyed it. If you enjoyed it, please subscribe, tell your friends, like us, and I will see you next Wednesday. Thank you. Bye.